So let's get straight into point one, which is about business deductions. So as I said, you're going to collect your fees, you're going to subtract your expenses, and what is left is what you get taxed on. So how much you're actually subtracting in business expenses is very important, because the more you can deduct, the lighter your tax bill gets. So everybody wants to know what they can deduct. Now, one nice thing about being self-employed is that frequently some of the things you can deduct are already part of your life. Like, you may not spend any additional money on rent when you become self-employed, but becoming self-employed makes some of your rent deductible. Some of your computer purchase is deductible. Some of your vehicle use may be deductible. So sometimes parts of taxes for self-employed people is just great, in that without spending any extra money, you actually just can file a tax return that makes you pay less in tax. So a salaried person may also have rent and a computer and a car, but they're going to pay tax on their full $500 salary, whereas you as a freelancer, a self-employed person, are not going to pay tax on that full $500. It's going to be $500 minus an allowance for all these expenses that you're spending money on. But beyond this, people want to know what the rules are about what you can deduct and what you can't deduct. So I'm going to start with the warnings about certain things. CRA does not have a rule about every single thing that you could ever possibly deduct, because basically that would mean a rule about every single thing that exists and can be purchased. So they don't have that. What they do have is certain restrictions and, rules about certain expenses, for one reason or another that they don't kind of like. And then beyond that, you're sort of, it's a little more of an open question, but let's start with some restrictions. One that a lot of people get wrong is meals and entertainment. So the Canada Revenue Agency more or less does not accept your groceries as meals and entertainment, unless you're basically buying groceries to feed to somebody else that is a business. I don't know. It's very hard to get away with groceries. Let's just say that. And the other thing is that a lot of people, if they have a long work day and then they go and grab something to eat, they want to write off that meal as a meal, a business meal. And there are some rules about that. Generally, if you're just if all it is that you worked a long day and then so you go and buy a meal, you can't deduct that meal. That's just considered sort of a personal expense. It's your problem. It's not part of your business. What is part of your business is two kinds of meals. One is a meal that you have with somebody else that can, in some interpretation, help you earn money. So this can be a colleague who's working out, who's giving you some information about a gig you might go for, or somebody who's potentially going to hire you for a gig. So if you're looking to get a gig playing at a wedding or something like that, and you have to meet with the bride, that if you spend money on that meal, you can write that off as a business meal, because it's a meeting with somebody who may be able to affect in a positive way your self-employed income amount. You're going to earn more self-employment income by having this meal with this person. That is a deductible meal. Make sure to write on the receipt who you met with and what the meeting was about, because if you ever get reviewed or asked questions about this by the Canada Revenue Agency, meals are something they like to check up on. So make sure that you have written on the receipt why it's deductible, which brings us, in other words, because it was a business meeting with so-and-so, which brings us to the other kind of meal that you can deduct, which is a meal while you're traveling. Now, to be traveling, for the purposes of this question, you have to leave your home region for a minimum of 12 consecutive hours. So if the gig takes you away from home for more than 12 hours and then you buy a meal, that meal is a legitimate business expense. So not the meal that is local and not the meal where you left town but you were gone for less than 12 hours. If you were gone for more than 12 hours and also, if you're gone and also for more than 12 hours, that meal is deductible. So I see a question here, for deductible meals, are alcoholic beverages and the tip also deductible? The tip, yes. The alcoholic beverage, maybe. The rule about alcoholic beverages is it has to be a reasonable amount for alcoholic beverages. they don't actually define it beyond that. So it seems to me like if you get reviewed on your business meals and there are a lot of alcoholic beverages in there, I'm not sure that even it's clear that the Canada Revenue Agency does not have a clear definition of what is allowable, as what is sort of reasonable amount. So I think you just have to be ready to defend that it's a reasonable amount. It's one of those things, there was a trial in the US in the 60s about pornography, and the judge ruled that I can't define it, but I know it when I see it. And so I think that's kind of where they've left the alcoholic beverages question is we can't define exactly what is a reasonable amount and what is not reasonable, but hopefully you know it when you see it, because that's as close as you can get. Sorry, that's not really very useful answer, but that's as much as I can tell you because that's all there is. Now, the business use of home. So this is a special kind of expense where essentially the costs related to the part of your home where you have a workspace or space that is sort of devoted to your self-employment income, that is partly deductible. So what happens is the way that the alcohol works. We all know how alcohol works. It does this to you. Okay. The way that the business use of home expense works is that you take the full cost of putting a roof over your head. That can be your rent, or if you own your own house, that can be your property taxes and your mortgage interest and your utilities and general repairs. And you end up with this giant number of what it costs to house yourself. And then you take the percentage of your space that is taken up by your workspace, usually your computer and desk and some storage space. And I know that a lot of times we're just working with a laptop and it moves from place to place. For the purpose of this calculation, you have to sort of pretend that you have a place, just a set place where you do your work. And you look at that floor space and you compare it to the total floor space of your home. This creates a fraction, and you multiply your total overhead cost by that fraction. And that's how you come up with business use of home. Got a question here. Is there a minimum distance for how far outside your region you have to travel for 12 hours? Not really. In Toronto, we generally say just the GTA. So, I mean, it isn't really clearly defined. It really isn't clearly defined. I would say that if you're traveling by car, like for like half an hour, you're getting pretty far from home, I would say. But basically all they really say is the home region. This is another not very useful question. But basically, okay, so what they're thinking is that if you're essentially like close enough to home, you should be just bringing a lunch. Like everybody has to eat. Everybody's supposed to be paying for their food out of their after-tax income. So at what point does this expense become an expense because of work? And they're saying that time alone won't do it. You have to also be far from home. Because if it's just time, you could just go home and eat and come back or something like that. So that's their reasoning. So if you think that you have a business expense that's an out-of-town business expense and you feel like it's kind of questionable, this is kind of what they're looking for, is that you kind of were too far from home to just go home and make a sandwich. So another question here, CRA looks at the length of time in a week you're using the space in the home, right? Well, it depends. If you have dedicated workspace, so a workspace that you use for your work and it does not become a personal space after hours. So if you work at the dining room table and then at night you take your computer away and you eat at the dining room table, now only certain hours are being used for business. And then what you have to do is further prorate your business use of home by how many of the hours in a week are used for business versus personal. If you have dedicated space where you have your work stuff and that is where you do your work and you don't do anything else there, then you don't have to prorate for the hours because it's basically all the hours. It is a dedicated workspace. But if it's not a dedicated workspace, if it switches tasks, then yeah, you're supposed to take into consideration how many hours, what fraction of your hours is this room used for business versus when does it revert to being your own space? So they can look at hours, but not necessarily if you have a dedicated space. Okay, so moving on, vehicle expenses, the process is really, really similar rather. You have the operational cost of the car, which includes things like gas, insurance, maintenance, repairs. All these are the costs that go into operating your car. There's also a certain amount of depreciation on your car. And then you make a fraction out of the kilometers that you drove for business compared to the kilometers that you drove overall. And so if it turns out that 1 in 10 kilometers that you put on the car was actually for business, then you get to take 1/10 of the operational costs and write them off as a vehicle expense. And there's also a certain amount of allowance for the depreciation. It's not really depreciation, it's amortization, but whatever. It's what you think of as depreciation of the car. And you also get to take a little percentage of it based on kilometers driven. So these are expenses that have really specific rules about them. But beyond that, there are literally an infinite number of things that you could potentially wonder if you can write off or not write off against your self-employment income. So when you get outside of these sort of known limits, you're dealing with expenses that maybe the Canada Revenue Agency has never thought of before, then you have to start to apply the CRA's own tax principle here. Because if you ever get reviewed or audited, it is the auditor is going to be applying this principle. So you have to know what it is so that you can apply it too. And you can argue with them on the same level, that you're arguing about the same thing. And that principle is the reasonable expectation of profit. So I'm going to quickly explain what this very important phrase means, reasonable expectation of profit. I'm going to go backwards one by one through the words. Profit. Profit only exists if the money that you earn exceeds the money you have to spend to earn that money. So you have a fee of $500. If your expenses exceed $500, then you don't have a profit. Okay, so making sure that the expense is less than the income it's supposed to earn for you or help you earn. Next is expectation. So it's the expectation of profit, meaning in the end, the expense may not have earned you what you wanted it to earn you. You may have actually spent more than it made for you. You may have spent money to get yourself listed in a certain directory, hoping it would get you the gigs, and it got you no gigs. So in fact, that expense exceeded the income generated. That's okay, as long as you had an expectation that it would make you more money than it cost you. So it was a good faith attempt to bring in more income. You write off the cost of that directory listing anyway. And the other thing is reasonable, that all of this has to be reasonable. So you have to expect profit, and that expectation has to be a reasonable expectation, an expectation of a reasonable person, not somebody, like in the throes of a cocaine high, right? Reasonable expectation of profit. So if you're ever being challenged on an expense, or if you're challenging yourself on whether you should deduct an expense, or in fact, if you are even deciding whether to spend money on your business, you're pondering whether to pay for that listing or purchase that extra gear, you should be applying this principle too, the principle of the reasonable expectation of profit. That you don't make a business purchase, or at least it's not a business purchase, if you did not have the reasonable expectation of profit. Now, deductions are one of those things that I have a whole bunch of resources on. I have a guide that's got a lot of information in it. It is written sort of from the perspective of a person who is involved more in the arts than in selling widgets or whatever. So it should be able to address questions that you might have about what can be deducted and what can't be deducted and where you put it all in a way that's sort of more sort of relates better to you than maybe the stuff that you can find on CRA's website. Now we're about to move on away from this question of business deductions. We have a little bit more to talk about that, but we're actually going to switch gears for a second, unless there are questions about what we've just talked about that you want to clear right now. Okay, I see a couple of questions that popped up really about the section before, so I will quickly answer them. I mean, can instruments be counted as business deductions? Yes, of course, but there are expenses which are written off in their totality for the tax year, and there are capital assets which are written off gradually over the course of many years according to certain rules that the Canada Revenue Agency lays out. The rules about capital cost allowance, or CCA, are way too complicated to get into right now, but ultimately you will write off the cost of your instrument. You just don't write it all off in a single year. And just to quickly talk a little bit about principles here, the principle behind this is a principle that in accounting is called matching. And matching is where you try your best to match a business expense to the income that it helps you earn. So when you earn income in the year, you're writing off the expenses for that year. But when you purchase an instrument, that is a large expense in 1 year that you will probably not be buying another bassoon the next year, right? You will be using that bassoon for many years, and it will be helping you earn income for many years. And the rules around capital assets and capital cost allowance are designed so that you're writing off a little of the expense every year against the income that it helped you earn in that year. So because the income that your instrument is going to help you earn is spread out over many years, by the same token, the cost of that instrument is also spread out over many years using the rules that are called under the umbrella of capital cost allowance. There is a little bit of information in that booklet that is about deductions. There's a bit of information about how to define the difference between a capital asset and an expense. If you come to us to do your taxes, we take care of the rules about capital cost allowance, but you should really know what the difference is between an asset and an expense. And by the way, that link that I had up there, it will come up again. I'll put it up again elsewhere in the talk, and I'm also going to probably send it out through the chat. So don't worry if you missed it; it's coming back as well. Question: the deduction for self-improvement applicable to performing artists. Can you comment on this? So I assume that we're talking about taking additional lessons and training to become better at what you do. So this is a great time to apply that rule of, does it give you a reasonable expectation of profit? Does the amount that you are paying to your teacher or your coach or your instructor, is it likely to generate at least the same amount in additional income? Because you become better, is your income going to go up? And is the price that you paid to become better no larger than the amount of additional income that it's going to help you make? Now, because you're an artist, you are willing to pay for self-improvement that will not make you more money. You're willing to do it just to self-improve. And so what I would say there is you might want to consider writing off on your taxes only a portion. So you write off the portion, like how much extra income do you think this is really going to help you make? Don't write off more than that in the cost of coaching. These are all impossible estimates, by the way. These are all impossible to guess at. Essentially, whatever decision you make as to how much of your professional development expense you decide to write off, be prepared that if and when the Canada Revenue Agency ever reviews this, that you will be able to defend that you had a reasonable expectation of profit. Because ultimately, that is always a discussion that you're going to have in an audit. Either that you need proof because you're either going to be looking for supporting documents, or beyond that, if you do have the supporting documents proving that you paid it, but they're saying, yeah, you paid it, but why should you be allowed to write it off? The argument you're trying to make is that you had a reasonable expectation of profit. If you feel that you can make that argument, you're willing to make that argument, go ahead and write it off. You might not win, but go ahead and write it off. And before I go any further, a little note about audits, which everybody always wants to know about. The chances of getting audited are always quite small, but they are never zero. And it's a bit like the weather in that you don't have any control. You really have almost no control over whether or not you're going to get audited. There are certain things that you can do, like claiming a lot of losses, that can encourage an audit. But generally, if you're going along in your life, there's not much you can do The audit is kind of random. It's going to happen or it's not going to happen. So basically, we try to teach you to take care of your stuff in such a way that you're always ready for the audit. It may never happen. It will probably never happen, but you're ready. And another thing to point out here is that if you've been writing off expenses all these years and you've never been audited, do not fall into the trap of believing that now CRA has approved of everything you've written off. It's not true. The CRA originally, when you file your return, takes your word for everything. It's an honor system. They just take your word for it. So until you've actually been audited and they've actually looked at those expenses, you don't know what they really think, right? They don't know exactly what you wrote off. What you file with the government is actually pretty broad strokes. They don't know. So just because you filed a return and you never heard back, that does not mean that you've been actively approved of by the government. It means that you've been passively ignored. So just be aware of that as well. Can the internet bill be considered as part of the business deduction? Yes, of course. I mean, without the internet, you can't make any money. We all know that realistically that is the case. Usually with our clients, we tell them to deduct no more than 50% of it because we all also use it for personal purposes. So yeah, write off maybe half your internet, but it's absolutely true that I don't know how you would in this day and age make a living without the internet. And therefore, as a person, you might decide to live like a monk and not have internet, but as a self-employed person, you know that that's suicide. Of course, you need to have, you have to have an internet connection. So I would say, yeah, write it off, write off part of it. Capital cost allowance would be great to get into if you can. I don't understand what that means, but it's a comment, not a question, so I'm going to move on. Okay, somebody would like me to break down the rules about capital cost allowance at the end. I'm not going to circle back. I'm going to actually break it down very quickly right now. You pay a certain amount for your instrument. You're allowed to write off a certain portion of it in the first year that you own it. So let's say we're just going to make the math easy. We're going to say that your instrument costs $1,000 and that the rules allow you to write off about $100 of that in the first year. Okay. So you have $1,000, you get to write off $100. Now there's $900 of cost that you have not written off yet. The next year, a calculation is applied to that. So let's say that you're allowed to write off 10% per year. This is not really accurate, but I'm just going to do it this way. So 10% per year. So you make your purchase $1,000. That year, you write off $100. You've still got $900 left. The next year, you can write off 10% of $900. So $90. You've got $810 left. The next year, you get to write off 10% of $810. This is where it's going to get hard. So you get to write off $81, which leaves you with hold on, 731, I think. No, 729. There you go, 729. And it goes on like that. So essentially what's left to write off kind of continually shrinks, but it never quite gets to zero, but it gets vanishingly small. And that's how capital cost allowance works. What category would music videos be deducted under? Advertising? This is a really interesting question. Really interesting. And I have a pseudo answer for you. It's not great. Yes, I would write it off under advertising. Now, what I will say is that outside of the expenses that have special rules, you know what, I'm going to go back just, you know what, I might as well post this because we're clearly not going to start talking about HST just yet. Outside of the items that have certain rules, all the other expenses can basically be, it doesn't really matter which category you use typically, because the expenses that don't have special rules, meals have special rules, capital cost allowance has special rules, business use of home has special rules, but everything else really doesn't. And mathematically, it doesn't matter where you put it, as long as you stay out of these special rule categories. So it doesn't really matter. On the other hand, and I will say that the Canada Revenue Agency, when you first file your return, doesn't see what you have written off for each category. They do not see the categories. Let me say that again. They don't see where you put your expenses. They just see your gross income and your net according to your calculations. They see nothing else unless they review you. So the process is that if they have no particular reason or interest in reviewing you based on your gross and your net, this is all they will ever know of that year's taxes. If they decide, for whatever reason, which can have sometimes has nothing to do with what you filed, but just as because you're a musician and this year they're reviewing musicians, then they ask for the breakdown. Only when you're getting reviewed do they actually get the breakdown. And then they like to zoom in on certain things. And I'm sorry to say that advertising is one of them. So you want to, yes, there are advertising expenses, of course there are, but you want to make sure, because advertising is a category where people tend to throw a lot of stuff like, well, you know, I spent money on a very expensive vehicle because that makes me look better, and therefore, you know, I had to get a two-tone sort of color shifting paint job on it, and I want to write that off because it helps me get gigs. It's advertising. So that kind of reasoning can be used by irresponsible people in very irresponsible ways. So I, on the one hand, would not really hesitate to write off a music video as advertising. But if you have a lot of other advertising expenses, maybe consider putting it somewhere else. Although I really don't know where else it would go. That would be my first guess, actually, advertising. Yeah. How many years back can CRA look back to audit a return? 7 years, and we're going to talk about that in more detail later on. I'm guessing auditions would be deductible, plane cost, hotel meals, etc. Does it matter if the jobs are out of country or out of province? Would they be treated the same way? Is it an expense that gives you a reasonable expectation of profit? Like you've been asked to audition and you expect to make much more money on the gig than it cost you to fly out there? Yeah, auditions typically would be. Now, if you're going to spend, you know, $13,000 on a first-class ticket to audition in Berlin for a gig that's going to pay you $700, you do not have the reasonable expectation of profit. So consider, all right? But yeah, in general, yes, the cost to go to an audition, if as a business person, you would say, yeah, it's worth giving it a shot because I think I'm going to make my money back and more. I've got a decent chance of getting this gig and being paid more than it cost me to do this, then yes. When in doubt, particularly when it comes to travel, which we all enjoyed in the before times, when it comes to travel, be very careful about this. Always apply this reasonable expectation of profit rule. Think about it as if you have a twin who wants you to pay for this expense, and you will get your money back if and only if it pans out. Would you take that bet? Would you give them the money for that plane ticket, knowing what their chances are? And if you say, yeah, I would, then go ahead and do it for yourself, right? Try to step away from the situation yourself and try to think, would this be a good business decision? Not a good artistic decision, but a good business decision. Because when it comes to taxes, we are talking about the business aspect of your business as an artist, not the artist aspect of your business as an artist. So make sure it's a good business decision. By applying reasonable expectation of profit, you should be able to take guidance from that. Okay, if you purchased your instrument in a year where you weren't actively making money using it, this is an excellent question. Still a student, not a musician, can you claim it in a future year, or does it have to be in the year that you originally purchased it? I have a very clear answer for this. You get to treat this capital asset as a new purchase in the year that you begin your work, your professional work as a freelance musician. But you don't necessarily take it in at the purchase price. You have to take it in at the fair market value price, which is to say that if you purchased an instrument for $1,000 in your third year of university, and you played it for 2 years, and then you became a professional in the third year, you have to figure out what that instrument, a 2-year-old student level instrument or whatever level it was, would sell for. What could you sell this instrument for to a stranger at the moment that you became self-employed? And that becomes the purchase price when you do your tax calculation. Okay, the fair market value of when you have what's called a change of use. You have something that was personal. It's considered personal use while you're still a student, becomes business use once you become a professional. So it's changed in use from personal to business. And at the time of change of use, how much was it worth on the open market? That's how you do it. Subcontractors like session musicians, collaborators, visual artists, etc. Does that go under the expense category, cost of goods? It can. You can go under, there's a section there, actually, there's a section in parts of the tax return that has room for a subcontractor. You can do that. But there's also a section called salaries, wages, and benefits. And I usually put subcontractors when we are doing a return for somebody who's like a band leader and they collect all the money from the payer and then they have to pay the musicians. We usually put the musicians down there in salaries, wages, and benefits. There's a place for it in the profit and loss form that you complete as a self-employed person when you're completing your tax return.